Hello everyone, welcome back to Victor's Food and Finance. This video is dedicated a little bit towards beginners, and I will share some or explain some of the basic expressions running around in investing circles and why people use them and what's the benefit basically. And we're going to start with evaluation or valuation. Valuation of a company is determined by its market cap. And what does that mean? Well, market cap is the current share price or last share sold on the market times all the shares outstanding. And then we're going to take a look at three different types of way to look at a company's earnings and profits. And first one of them is net profit, which is earnings minus expenses, taxes, interest, and so on. This is shows the company's profitability over time. Second one used is something called EBITDA. It stands for earnings before interest, tax, depreciation, and amortization. And this is earnings excluding some things. Like I said before, it's within the name, so it excludes interest payments, tax payments, depreciating assets. For example, if a company buys a computer, that is, when you buy it, it has a value, and then it, in general accounting principle, it's depreciating over a 5-year period. So it comes up as a cost of 20% per year over 5 years, and is deducted from the balance sheet, essentially. And then you have finally amortization, which is repayment of debt. And this is also a different way to look at the company's profitability. I don't use this metric all too often. And then the third one, my final one, which I use mostly when I look at a company's earnings, and it's the cash flow statements. It's cash in and out of the company. You can make earnings look better than they are with a little bit of accounting tricks. Generally, serious companies don't do that, but in cash flow statements, cash in and out of the company is accounted for when the cash transaction occurs. And cash flow is divided into three different parts. First, you have cash flow from operations, which is the everyday, day-to-day business, where you include sales you sell things and then you make profits, and then you pay wages, interest, taxes, and other expenses. And this can be useful for, you can ask the question, how much money does the core business generate when it's running its day-to-day activities? What is not included in cash flow from operations? Well, cash flow from investments. And what is that? Here is another term called CapEx, or capital expenditures. It means basically investments for the future to stay competitive and be able to grow the business. So it can be as simple as maybe buying a new office space or something like that. It's it's not a depreciating asset, you say. It's some companies, they are pure real estate companies. They just buy real estate and then they generate income from renting it out. And the real estate itself is considered an investment. It's not a depreciating asset. It's something that grows. Also physical assets like materials, investments, as well as acquisition and divestment. So if you buy another company, merge companies, or you spin off or you sell a part of your business, that would also be cash in or out, and that would be shown up in the cash flow from investment section. And finally, we have cash flow from financing. And here you have things like dividends, buybacks, and debt repayments. And an interesting answer you get from this financial statement is perhaps how much cash does the company return to shareholders on a yearly basis or historically. Okay, so what can we use these earnings and cash flows for? Or what are they used for? And I'm going to talk about earnings multiples. It's often talked about earnings multiples. And what are earnings multiples? Well, it's essentially answer the question, how many years does it take for the company to pay for itself, or the price you paid for the stock with last year's earnings. And for this, you compare the total market cap of the company with its earnings. The most simple one is called simply price to earnings. There is something called enterprise value to EBITDA. And there is also price to free cash flow. And it's essentially the market cap compared to last year's profit. And this way you get a number. And as an example, I'm going to show you two companies, each with a market cap of $1 million. Very simple example. Company one makes $100,000 profit. It would take that company 10 years to regain that $1 million worth of market cap, hence a price to earnings ratio of 10. And then if you have a company two, then makes half that amount of money, $50,000 a year, that would lead to a P of 20. So twice as long for the company to make half as much to regain the $1 million. And then the question becomes, is then company one better to invest than company two because it has a lower price to earnings ratio? Well, that's not necessarily true, because that has to do with growth and future growth. For growth and future growth, it's always a very difficult topic. You have a bunch of experts making predictions, because you do have to make a prediction and some type of forecast. And I divide these prediction in two different categories. So one is more based on numbers and statistics and the company's financial history. You also take into account other companies within the same business sector, and you compare the evaluation to its peers, essentially. And this is obviously not exact science, but you can make estimates and educated guesses based on math and numbers. And then you have the little bit different, like more what I call external factors, like macroeconomic factors. That is, for example, interest rates from central banks. You might have geopolitical tensions, like tariffs, or you might have geopolitical risks in some regimes, like I don't know, Russia. They might seize your assets over there, or private companies' assets. Then you have things like environmental factors. It could maybe be weather. If you have a business operating, I don't know, ski lifts, for example, if global warming changes the conditions, maybe you can't ski because the climate gets too hot. Then you have things like technological advancements as well. They're going on the same train of thought. Ski resorts, maybe you have snow cannons that can compensate, and you can ski maybe in a plus couple of Celsius degrees. We make it possible. Now, these type of external factors are very, very difficult. I would almost say impossible to predict. You can make some type of long-term assumptions. Maybe fossil fuels are used to a lesser extent. Maybe electric vehicles and so on, you think is more of a future, but it's much more speculative, the whole thing. And here are really some macroeconomists that come on televisions and make wild forecasts for companies. And AI is going to revolutionize technological paradigm shifts or so on. And it's I usually tend to try to avoid companies that have too much uncertainty externally. Now, it creates essentially risk and uncertainty, this type of stuff. Generally, it's overblown by the public due to fear. And there can also be positive effects, both for society and individual companies. These type of things can have both positive and negative effects. And most importantly, it can lead to big repricing in market multiples. So if you have some type of business that you expect will be growing for the future, but then certainly a new technology or things change, then there is no future prospects for it. Example would be maybe if you had a business in video rentals back in the day, if you remember, renting out DVDs and VHS and stuff, that has basically gone out of business because you can stream things online and get videos on demand. How do we use these things that we have talked about today to be successful in our investing? Well, like I maybe mentioned before, try to avoid companies that are too much impacted by external factors, like the things I mentioned above. Whether environmental changes, technological advancements, macro changes, and so on, that you are always going to have some type of reaction, but that are less impacted from these kind of things. And maybe, try services or products that have been around for a long time and will be around for a long time. It's important to invest in something that will be around. You want to also mainly focus, I at least recommend, on publicly traded companies, larger companies with a good track record, and avoid startups. Obviously, you can't expect outsized returns either on these type of, because they are more researched by investors and more followed, but they are also much safer, and you want to avoid losing money. You want to also understand the product or the service, something that is close to you, and also try to understand how that service or product makes money, because there are good services and products that are not very profitable. Another thing to think about is barriers to entry. So you should not be able to easily copy what the business you invested in is doing. If anybody can do it from their mom's basement, it's not really difficult to replicate. And also focus on something with a competitive advantage. It can be simply a strong brand or better marketing, or it can be that the product is significantly better in some way. Yeah, same goes back. Go in something that you understand yourself. There is usually you have a natural advantage. Almost every person has in something, whether it's your hobby or whatever you are doing. And there is almost always a product that does well. And finally, try to buy at a reasonable price, and for the long term. And with that, I can maybe help you a little bit to choose something at a good price, if you trust my judgment. Okay, everyone, thank you for staying with me today. I hope you all learned something, and press the like and subscribe button, and see you next time.